Welcome back to Trading Club 7U, where we're dedicated to helping you learn trading from the ground up. Today, we're on lesson number 40, in Module 3 Technical Tools. Our topic is the RSI, momentum, and some common myths surrounding overbought or oversold conditions. Have you ever wondered why some trading strategies seem to work on a chart, but then suddenly fail spectacularly? This often comes down to understanding the intricacies of momentum and the Relative Strength Index, or RSI. Let's start with the basics. Momentum is a measure of an asset's upward or downward trend. Think of it like a running car on the highway. If the car is gaining speed, you can say the momentum is positive. But if it starts slowing down, the momentum becomes negative. It's simple, but it's crucial to grasping momentum trading. But how do you quantify this? That's where indicators like the RSI come in. The RSI measures the magnitude of recent price moves in relation to the asset's overall price. By using a value between 0 and 100, it can give us an idea of whether an asset is overbought or oversold. For instance, let's consider Apple stock. If we observe that the RSI is at 90 on the chart, it might be a sign that Apple is overbought. This doesn't necessarily mean the price will drop, but rather that it's become expensive relative to its recent price moves. Conversely, if the RSI dips below 30, it could be indicating oversold conditions, but once again, it's not a guarantee of a price bounce. A crucial point to remember is the RSI doesn't guarantee reversals. Think of it as a flag waving in the wind. The flag may be red or green, but the wind can change at any moment. Similarly, the RSI can show overbought or oversold conditions, but it's up to you to determine the right moment to act. Now, let's tackle the common myths surrounding overbought or oversold conditions. Many traders believe that once an asset reaches 70 or 80 on the RSI, it's guaranteed to reverse. Or, conversely, that an RSI of 20 is a dead giveaway of a trend reversal. The truth is, the RSI is simply a guide. Each asset behaves differently, and the key is to understand the context. For example, let's consider two different stocks XYZ and ABC. Both stocks have their RSI values at 80, indicating they might be overbought, but their price action is different. XYZ is continuing to rise, while ABC is starting to show signs of slowing down. In this case, even though both stocks have similar RSI values, we might be looking for a potential reversal in ABC, and not in XYZ. Another mistake common among beginners is over-relying on other indicators, such as moving averages or stochastic oscillators. Don't just look at one or two indicators, consider the bigger picture. Always, before making a trade, ask yourself what's the momentum, what's the overall trend, what's the support and resistance level, what's the chart setup. For instance, if we have an asset with a strong uptrend but the RSI shows overbought conditions, we might be looking for a potential pullback, rather than a complete reversal. We could use this information to add to our long position, expecting the trend to continue. Now, let's do a practical exercise. Use a demo chart or a paper trading journal and apply the RSI to your favorite asset. See how the indicator responds to different price moves. Take note of when it shows overbought or oversold conditions, but also consider the bigger picture. Practice making trading decisions based on RSI and other indicators. Take note of how each trade performs and reflect on your mistakes. Recall the key points: the RSI is a guide, not a predictor. The RSI doesn't guarantee reversals. Each asset behaves differently. Stay vigilant, consider multiple perspectives, and hone your skills before risking real capital. And remember, trading is a journey, not a destination. In the next lesson, we'll be diving deeper into some more advanced technical tools. We'll explore more on how to use the RSI in conjunction with other indicators and strategies. So stay tuned, and keep practicing. Finally, take a deep breath and acknowledge that trading is not just about the numbers, but also about your own emotional well-being. Managing emotions during trading is as important as technical knowledge. Practice, persistence, and a clear mindset are essential for mastering these skills. Remember, the goal is to become an autonomous and disciplined trader, rather than a reactive trader.